Forget everything you think you know about AI investing. While everyone's fighting over Nvidia and Microsoft, the real winners of the AI revolution are hiding in plain sight. And I'm not talking about some obscure tech startup or crypto coin. I'm referring to two giant oil companies that Wall Street is completely overlooking. Today, I'm going to reveal the hidden AI stock that could make you rich while others are chasing overvalued tech names. We'll dive deep into the ultimate energy battle between Exxon and Chevron, uncover the $53 billion Guyana gamble that could change everything, and show you exactly how to position your portfolio for what I believe will be the most profitable investment opportunity of the next decade. This is Warren's Money Buffet, and I'm about to expose the secret that's hiding in plain sight. The AI revolution doesn't run on magic. It runs on electricity, and there's only one fuel that can bridge us to the AI future fast enough. Stay with me because by the end of this video, you'll understand why these so-called boring energy stocks could deliver returns that put the hottest tech stocks to shame. Welcome to Warren's Money Buffet. Join our Market Masters community to unlock your financial potential. Discover innovative investment strategies and grow your wealth with us. Don't miss out. Like, subscribe, and comment to stay updated with Warren's Money Buffet. Get ready to transform your financial future. Elevate your insights on Substack. Our premium tier offers exclusive portfolio access and monthly deep dive reports. Free updates are also available. Become a founding member for personalized portfolio reviews and exclusive Q&A sessions. Gain priority access to all our new content and insights. Remember, our content is for educational purposes only. Investing involves risk, and we are not financial advisors. Always do your research. Here's what nobody's talking about. Data centers consumed 187 terawatt hours of electricity in 2024. That's enough to power 17 million homes for an entire year. But here's the shocking part. By 2030, that number is projected to reach 450 terawatt hours. We're talking about more than doubling AI's power consumption in just 6 years. Think about what that means. Every ChatGPT query, every AI image generation, every autonomous vehicle decision requires massive computing power. And that computing power requires electricity, lots of it. We're not just talking about a little bump in energy demand. We're talking about adding the equivalent of 40 million new homes to the electrical grid, all running 24 hours a day, 7 days a week. Now, here's where it gets interesting. Everyone thinks renewables will solve this problem. Wind and solar energy sound great in theory, but they have one fatal flaw for AI applications. They're intermittent. When the wind stops blowing or the sun stops shining, those AI data centers don't just pause and wait. They need constant, reliable power every single second of every single day. Here's a recent clip from the CBS Evening News on the AI data center power demand that is for real.
Well, if your electric bill has gone up lately, you are not alone. And it may not just be the summer heat that's causing things to rise. Artificial intelligence data centers, or physical buildings or facilities that house computer systems, are predicted to drive demand to record highs in the coming years. CBS News national environmental correspondent, I should say, David Schechter joins us now to break all this down. David, always a treat to see you. This makes sense in some ways, but still surprising to hear just how much energy our data centers using and how is that affecting our electric bills?
Hey, Nancy, data centers have a voracious appetite for electricity, and so they really are a driving factor in our country not having as much electricity as we need and this push to develop more. If you look at it this way, for example, let's talk about an internet search. If you do an AI search versus just a regular Google search, that requires about 10 times more energy on the processing end to get that answer. If you think about the city of New York, they on a daily basis, their load of what they need to run that city is called 6 gigawatts, which probably doesn't mean a lot to anybody, but when you think about it, by 2030, the country needs 3 times that amount of energy to keep up with the growth of the data centers. So there's a huge appetite for this new energy. At the same time, our energy bills are going up. The state of New Jersey on June 1st said many people's bills will go up 20%, partially because of AI. There's a lot of other reasons, but that is a driver. These data centers are a big driver. And one more quick point, I wrote this down. Connecticut, 71% increase in average residential bills in the last few years. California, 46%. Texas, 27%. Again, not all because of data centers, but they are playing a big role in this thirst for new energy.
Yeah, you talk about those higher prices. Are there risks beyond that? Could this end up affecting the grid itself here?
I think there are strong concerns that it will impact the reliability of the grid because, in many places, like I'm here in Texas, the margins are very thin. And on a very hot day, there's just enough electricity to meet the demand, and they manage that very closely. But then when you have all these, usually you bring on new sources of things that demand energy slowly, new plants and things you plan for over time. But there's such a rush to build these data centers, and they're so big that there is a lot of concern about the reliability. Will that cause brownouts across the country? And this is what regulators are looking at very closely.
Well, given this rush, what are the environmental consequences of this big data center boom we're seeing?
Yeah, well, these data centers are powered generally by fossil fuels right now. Fossil fuels contribute carbon dioxide to the atmosphere, which warms up our planet through climate change. And as they put in these data centers right now, it's just sort of a mad rush to where can we get the power? Where can we get the power? So the cleanliness of the power or the renewableness of the power is not the top priority at the moment. It's like we just need this energy.
Nuclear power could eventually solve this, but here's the reality check. The first small modular reactors won't come online until 2030 at the earliest. Most won't be operational until 2033 to 2035. But AI companies need power today, not in 8 to 10 years. They can't wait for nuclear to catch up. So what's the only energy source that can provide 24/7 reliable power and can be deployed in just 2 to 3 years instead of 8 to 10? Natural gas. It's the bridge fuel that everyone's overlooking, and it's about to become the most important commodity in the AI revolution. This brings us to the ultimate showdown between America's two energy titans, Exxon Mobil and Chevron. On the surface, these companies might appear similar, but dig deeper, and you'll find two completely different investment stories. Let's start with the tail of the tape. Exxon has a market capitalization of $471 billion, compared to Chevron's $251 billion. Exxon generated $33.2 billion as net income last year, while Chevron managed $21.4 billion. When it comes to free cash flow, Exxon produced $36 billion, compared to Chevron's $19 billion. This isn't a fair fight. Exxon is nearly twice the size of Chevron in every meaningful metric. But here's where it gets really interesting. Despite being much larger and more profitable, Exxon actually trades at a discount valuation. Exxon's price-to-earnings ratio is 14.5 times that of Chevron's, which is 16.4 times. So you're getting more company for less money. Now let's talk about their AI energy strategies, because this is where the real differentiation becomes clear. Exxon announced plans to build a 1.5 gigawatt natural gas power plant specifically designed to power data centers. That's enough electricity to power 375,000 homes, and they're incorporating carbon capture technology that will reduce emissions by over 90%. Exxon Mobil is uniquely positioned to capitalize on this burgeoning demand. Their vast natural gas reserves, particularly in the Permian Basin, are strategically located near the very regions experiencing a boom in AI data center development. Exxon's integrated operations mean they can efficiently supply the natural gas required to fuel these energy-hungry AI facilities, creating a direct and powerful synergy between their core business and the future of technology. This strategic alignment offers a compelling investment narrative. Now, let's turn our attention to Chevron and a significant point of contention: their proposed acquisition of Hess Corporation. This $53 billion deal is currently embroiled in a complex arbitration process, primarily concerning Hess's stake in the lucrative Stabroek Block offshore Guyana. This legal uncertainty casts a considerable shadow over Chevron's immediate future and its ability to fully integrate these valuable assets. The outcome of this arbitration is not just a procedural detail. It could fundamentally alter Chevron's growth trajectory and its competitive standing in the global energy landscape. Investors must weigh this significant risk carefully. Chevron is pursuing a partnership strategy with Engine Number 1 and GE Vernova to build what they call power foundries, natural gas plants directly connected to data centers. Here's where Exxon's advantage becomes crystal clear. Exxon dominates the Permian Basin, which produces 22% of all U.S. natural gas. Their recent $59 billion Pioneer acquisition made them the undisputed leader in American energy production. They can build natural gas plants because they control the fuel supply from wellhead to power plant. Chevron, meanwhile, has bet its entire future on a $53 billion acquisition of Hess Corporation. The problem? They might not actually be allowed to complete that deal. And that's where our story takes a dramatic turn into the jungles of South America. Deep in the Atlantic Ocean, 120 miles off the coast of Guyana, lies one of the most valuable oil discoveries of the past 50 years. The Stabroek Block is estimated to contain 11.6 billion barrels of recoverable oil reserves. To put that in perspective, at current oil prices, we're talking about roughly $1 trillion worth of oil sitting on the ocean floor. We are now going to break away for a more detailed explanation of Guyana, this oil discovery, and the relationship with Exxon.
Everything changed for Guyana, a country the size of Idaho, in 2015.
Exxon Mobil says it has made a significant oil discovery off the coast of Guyana.
Guyana joined the ranks of the world's oil producers for the first time on Friday, as U.S. oil company Exxon Mobil said it began producing crude off the coast of the South American country.
Exxon made a major discovery that then led to a string of discovery after discovery after discovery. And at that time, Guyana, like many of the countries that we work with, had only a couple people in government who really were familiar with the oil and gas sector, and so had to quickly ramp up its capacity in order to oversee this rapidly growing sector.
They started drilling in 2019, it started producing in 2019. So production has gone from basically zero to almost, it'll be 600,000 barrels a day of oil by the end of next year. And that production is going to double to almost 1.2 million barrels by the end of 2027. So the growth trajectory has been tremendous.
The only English-speaking country in South America has been witnessing tremendous economic growth since the discovery of oil. This chart from the International Monetary Fund shows how its GDP has skyrocketed since it began pumping oil in 2019.
Really massive changes to the economy in the last 2 years, and we're expecting that to continue for the foreseeable future.
It's a moment of great excitement in the economic landscape of the country. The challenge, though, it's really too tied to the oil and gas industry.
Guyana is one of the great success stories in the oil industry in the Western Hemisphere of the last 10 years. It has gone from being a relatively impoverished, poorer country to one of the richest countries in South America on a per capita basis. And it stands to increase its wealth as it continues to grow its oil production.
U.S. oil giant Exxon and its two partners, Hess and the China National Offshore Oil Company, have discovered more than 11 billion barrels of oil in Guyana since 2015. Guyana's economy has exploded since then. Critics argue that Exxon Mobil is reaping the most benefits from this oil bonanza.
For many years, there's been controversy surrounding Guyana and Exxon's oil deal, with many critics within Guyana challenging the validity or the soundness of that deal because it's very much to the advantage of Exxon.
It's a one-sided deal because Exxon pays no taxes. Exxon didn't put up the insurance they're responsible for putting up. Exxon has a special arrangement where they maximize profit first. They get their profits first and Guyana gets theirs later.
On the question of whether the arrangement with Exxon is fair or not for Guyana, I was with it from the very beginning, and maybe that's way I think it was a fair, or I think it is a fair arrangement. It is a production sharing arrangement.
Deals get struck, and sometimes the deals don't always favor you in all of the aspects, and I think that Guyanese have to embrace that if they want to continue to participate in this broad global setup, and to say, how do we ensure that the terms going forward?
For all the international oil companies, they look for big finds, and Guyana is the biggest that anyone has found in a long time. And there may not be other giants, as they're called in the business, that are left. So it's extremely important. And I think that's why you see Exxon Mobil play such a high priority, not only on the development of the asset, but on the development of the country. Because for international oil companies, these are 30-year projects. They're going to be there for a long time. And so if the country doesn't succeed, neither do they.
Guyana is very close to the United States. It's close to the Gulf of Mexico, where the United States has an enormous array of refinery and oil and gas refining infrastructure. So a lot of Guyana's oil will go to the United States and potentially could be consumed by the American market. So the United States is in a pretty strong position to benefit from the exploration and expansion of Guyana's oil, both in terms of corporate infrastructure and also in terms of the American economy.
The geopolitical considerations surrounding Guyana's oil wealth are immense. The Stabroek Block is one of the world's most significant recent oil discoveries, attracting intense interest from global powers. The United States and China, among others, recognize the strategic importance of these reserves for future energy security. This isn't merely a commercial dispute, it's a geopolitical chess match where control over vast energy resources can shift global influence. The arbitration involving Hess's stake is therefore not just about corporate assets, but about the broader strategic implications for energy supply chains and international relations. The arbitration over the Stabroek field in Guyana is a high-stakes battle with profound implications for both Exxon and Chevron. Here's how the ownership breaks down. Exxon Mobil operates the field with a 45% stake. China's CNOOC owns 25%, and Hess Corporation owns the remaining 30%. Production began in 2019, and the field currently produces 645,000 barrels per day. By 2027, production is expected to reach 1.3 million barrels per day, making Guyana one of the world's fastest-growing oil producers. Now here's where the drama begins. In October 2023, Chevron announced its acquisition of Hess Corporation for $53 billion. However, there was one minor problem. They overlooked the fine print in the joint operating agreement. Exxon and CNOOC claim they have a right of first refusal on any sale of Hess's stake in the Stabroek Block. Exxon, as the operator of the Stabroek Block, asserts its preemptive rights over Hess's stake, challenging Chevron's acquisition. The outcome will determine not only the future of the Hess assets, but also the long-term competitive dynamics between these two energy titans in a critical growth region. This legal dispute is a pivotal event that demands close attention from investors. Here's Exxon's CEO, Darren Woods, on the significance of Guyana's oil field.
One of the highlights that you point out is the gross production numbers that you're seeing now in Guyana. 600,000 oil equivalent barrels a day there. I mean, that has turned out to be a hugely important stake for you.
Yeah, it's, I think, a great example of the capability of this organization and each of the different sectors coming together, our technology company, operations company, our projects company coming together to make these things possible. We deliver these projects at an industry-leading pace. We deliver them ahead of schedule, below budget. And when we bring them on, the operations teams start optimizing, and we tend to reset what we think is possible and very safely raise the production to a point where we are now running those three ships, those production units at a rate higher than what we made the investment decision on. So extremely proud of that. Of course, we've got 3 more in the works I feel really good about. So this is a tremendous example of what the organization is capable of doing.
But the production that you've seen in Guyana is, I'm sure, part of the reason that you're involved now in this arbitration with Chevron. Chevron wants to buy Hess. Hess is a 30% partnership in that deal with you. You guys have a 45% stake in it. What's the arbitration over, and what do you think is likely to happen here?
So I think great context for that discussion. And if you look at Guyana and the development there, I think it will go down as one of the best deep water developments in the history of the industry. So a lot of value that's been created through the hard work of the partners, but specifically with our engineering organization and our projects organization. So understand why Chevron's interested in participating in such an attractive development. The partnership that exists today is run or defined by a joint operating agreement. That agreement gives existing partners rights when there are changes in controls. The Chevron Hess transaction ignored those rights. We're standing up for the rights to make sure that we protect the value that we've created there, to make sure we understand what the Guyana assets, the value of those assets are in the Chevron Hess transaction, and make sure that we have a line of sight to how best to optimize value for our shareholders.
I'm sure you understand Chevron's position. I'm sure they've explained it to you. They are saying that there's a Hess subsidiary that won't change, and they think that that is enough to satisfy what they're calling a contract language dispute. That they think is something that's routinely put in and usually is not taken up by the other partners. How is this different, and how do you think it'll play out?
Well, I am familiar with their argument and their interpretation. We wrote the JOA, so we have a pretty clear line of sight as to the intent and the circumstances that apply and the language that applies to these circumstances. So we feel pretty confident in our interpretation. And frankly, that's the point of the arbitration. The JOA allows for that. It's understandable that partners from time to time can have a different interpretation of that. We'll take it through the arbitration process and we'll let the facts speak for themselves.
Would you put in a bid yourself if arbitration allowed you to do that? You guys are still caught up with Pioneer Natural Resources trying to digest that major acquisition. Would you have the money to go ahead and try and put a bid in for these assets as well?
I've made it clear in the past that this is not a play for Hess. We're not interested in a transaction on Hess. This is really around protecting the value that we've created as part of that development, making sure that the preemption rights that we believe exist in the JOA are recognized and confirmed, and then understand what the value they're putting on that asset is, and then what the options are to maximize the value to their shareholders. So
what does that mean, Darren? I'm sorry, just to
now.
dig into it, does that mean you're not looking to buy Hess outright, but you would be looking to buy these assets, or you just want to be compensated and maybe push for a higher deal for those assets where you guys are compensated as well?
I think there are a lot of options on the table, Becky. I'm not limiting myself to any one. We're going to look and see what the cash value of that. First of all, we'll confirm the rights of preemption, and then we'll look to see what the cash value of this asset is within that transaction, and then we'll explore the opportunities that are available to us.
The arbitration hearings concluded in London in May 2025, with a decision expected by September 2025. Legal experts give Exxon a 40 to 50% chance of winning, Chevron a 35 to 45% chance, and about a 10 to 20% chance of some kind of compromise settlement. However, what makes this even more interesting from a geopolitical standpoint is that Guyana's President Irfan Ali has publicly supported the existing partnership structure, providing what he calls categorical assurances against renegotiating the original 2016 oil contract. The United States views Guyana as a key energy ally, helping counter Venezuelan and Russian influence in the region while providing an alternative to Middle Eastern oil. China's CNOOC stake adds another layer of complexity. The U.S. government views Chinese control of American energy resources as a national security concern, which could influence how this arbitration is resolved. If push comes to shove, Washington likely prefers Exxon's control over Chevron, sharing ownership with Chinese interests. When we compare the financial health and operational efficiency of Exxon and Chevron, Exxon clearly demonstrates superior strength. Examining key metrics, Exxon boasts significantly higher cash reserves for projects, indicating a robust capacity for future investments and growth. Their debt-to-equity ratio is remarkably lower, signifying a healthier balance sheet and reduced financial risk. Furthermore, Exxon generates substantially more free cash flow, providing greater flexibility for dividends, share buybacks, and strategic initiatives. These economic indicators underscore Exxon's operational excellence and its stronger position to navigate market dynamics and pursue growth opportunities. Now, let me explain why Exxon is positioned to be the ultimate winner of the AI energy revolution, regardless of what happens in Guyana. First, let's talk about scale and infrastructure. Exxon's Permian Basin operations span 1.4 million acres with 16 billion barrels of oil-equivalent resources. This isn't just about oil. The Permian produces massive amounts of associated natural gas as a byproduct of oil drilling. The current production of 1.5 million barrels per day is targeted to reach 2.3 million barrels per day by 2030, representing a 53% increase. This gives Exxon a vertically integrated advantage that Chevron can't match. They control the natural gas from the wellhead, have the pipeline infrastructure to transport it, and are building power plants to convert it into electricity for data centers. It's the ultimate picks and shovels play for the AI gold rush. Second, let's examine their financial fortress. Exxon's debt-to-equity ratio has dropped to just 0.18 times, compared to Chevron's 0.37 times. They generated $13 billion in operating cash flow in the first quarter of 2025 alone, putting them on pace for over $50 billion annually. This financial strength enables them to invest heavily in AI energy infrastructure while maintaining their dividend and share buyback programs. Third, their technology advantage is underappreciated by Wall Street. Exxon operates the world's most significant carbon capture and storage network, comprising over 900 miles of CO2 pipelines and 16 million tons per year of contracted storage capacity. When they build natural gas plants for data centers, they can capture and store over 90% of the emissions, making them a clean energy solution that bridges the gap to nuclear power. Fourth, their LNG growth story provides international diversification. Exxon is targeting 40 million tons per annum of LNG capacity by 2030, up from about 30 million tons today. As AI infrastructure expands globally, especially in Europe and Asia, this LNG capacity becomes critical for powering international data centers. However, what sets Exxon apart is its proven track record of execution. While Chevron has struggled with project delays and cost overruns, Exxon has consistently delivered projects on time and budget. Their Pioneer integration is ahead of schedule, generating $3 billion in annual revenue. When they commit to building AI energy infrastructure, investors can have confidence they'll actually deliver. While Exxon's valuation, particularly its EV/EBITDA, might appear at a premium compared to the industry average, this is a justified reflection of its unique strategic advantages and future growth prospects. The market is recognizing Exxon's unparalleled access to low-cost, high-margin resources, its operational efficiency, and its strategic positioning to capitalize on emerging energy demands, such as those from AI data centers. This isn't an overvaluation. It's an acknowledgement of a company that is fundamentally better positioned for long-term value creation, offering a compelling investment case despite a higher multiple. Understanding oil price sensitivity is crucial for energy investors. While oil prices naturally impact profitability, Exxon's diversified portfolio and strategic focus on natural gas for AI demand provide a degree of insulation. For instance, a $10 per barrel decrease in oil price might lead to a $1 reduction in EPS, but a $10 increase could yield a $1 gain. More importantly, the underlying demand for natural gas from AI data centers is less correlated with fluctuations in crude oil prices. This means that even in a scenario of lower oil prices, the robust demand for natural gas can provide a stabilizing force for Exxon's earnings. The AI thesis for natural gas is compelling, even in a world of potentially lower oil prices. Cheaper energy inputs driven by efficient natural gas production directly benefit the energy-intensive operations of AI data centers. This creates a virtuous cycle where lower natural gas prices make AI operations more cost-effective, further stimulating demand for natural gas. Crucially, the demand for natural gas to power AI is largely uncorrelated with crude oil prices. Furthermore, governments are increasingly recognizing the necessity of reliable baseload power for technological advancement, leading to supportive policies for natural gas infrastructure. Looking ahead to Q1 2025, the performance outlook for Exxon and Chevron highlights their differing trajectories. Exxon is projected to deliver strong earnings and robust cash flow, reflecting its operational efficiency and strategic advantages. This financial strength provides the flexibility for continued investment and shareholder returns. In contrast, while Chevron may show solid cash flow, The ongoing arbitration surrounding the Hess acquisition introduces a significant element of uncertainty. This legal cloud could impact their ability to fully realize the benefits of the deal, potentially hindering their growth and dividend prospects compared to Exxon's more stable outlook. Several key milestones are on the horizon that will shape the investment landscape for these energy giants. By September 2025, we anticipate a resolution to the critical arbitration concerning the Hess acquisition, which will provide much-needed clarity for Chevron. As we approach December 2025, a recovery in natural gas prices is expected, driven by increasing demand from industrial sectors and, crucially, from the expanding AI data center market. Finally, by Q1 2026, we project that new natural gas plants specifically designed to power AI operations will begin coming online, solidifying the long-term demand for natural gas. Regarding the arbitration, our analysis suggests a nuanced probability distribution. We estimate a 45% chance of an Exxon win, which would significantly bolster their position in the Stabroek block and potentially reshape the competitive landscape. There's a 40% probability of a Chevron win, which would allow them to proceed with the Hess acquisition, albeit with potential concessions. Finally, there's a 15% chance of a prolonged dispute, which would introduce continued uncertainty and potentially delay the full realization of the Stabroek assets for either party. Investors should factor these probabilities into their risk assessment. For investors looking to capitalize on the energy sector's role in the AI revolution, a strategic portfolio allocation is key. If you wish to play both stocks, a balanced approach is advisable. We recommend a portfolio weighted with 60% in Exxon, reflecting its superior financial strength, strategic positioning, and lower risk profile. A 20% allocation to Chevron allows for exposure to their assets while acknowledging the current arbitration uncertainty. The remaining 20% in cash provides flexibility to capitalize on market opportunities or mitigate unforeseen risks. This allocation balances growth potential with prudent risk management. Considering all factors, the undeniable demand from AI, the strategic importance of natural gas, financial strength, and the ongoing geopolitical and legal dynamics, the clear winner in this investment thesis is Exxon Mobil. Their unparalleled assets, operational efficiency, and strategic alignment with the future of energy demand position them as the premier choice for investors. Now, what does this mean for your portfolio? It means it's time to dig deeper into Exxon's specific projects, their long-term growth strategy, and how you can best position yourself to benefit from this powerful convergence of energy and artificial intelligence. Now, let's dig deep into Exxon's financial metrics to understand why this isn't just a good investment. It's potentially a generational opportunity. Starting with their latest earnings, results from the first quarter of 2025. Exxon reported earnings per share of $1.76, beating analyst expectations by 2 cents. While the revenue of $83.1 billion missed expectations by about $3 billion. The earnings beat demonstrates their ability to manage costs and maintain profitability, even in a challenging environment. Looking at the upcoming second quarter, analysts are estimating earnings of $1.50 per share and revenue of $79.2 billion. What's notable here is that analyst revisions have been trending negative, with 22 downgrades versus only 2 upgrades over the past 90 days. This sets up a perfect contrarian opportunity. When expectations are low, it's easier to surprise to the upside. Now let's examine their profitability metrics, because this is where Exxon shines. Their gross margin of 30.79% exceeds the sector average of 28%. The net profit margin of 9.73% exceeds the sector average of 8.5%. Return on equity of 12.14% outperforms the sector average of 11.5%. Across every primary profitability metric, Exxon grades out as an A+ compared to its peers. We will now listen to Exxon's CEO Darren Woods talk about Exxon's earnings.
Exxon Mobil earnings beating expectations, beating those estimates. We saw that earlier this morning. The stock has been higher in the trade session this morning, up by about 0.5% right now. Joining us in a CNBC exclusive is Exxon Mobil's chairman and CEO, Darren Woods. Darren, good morning. Thank you for being with us this morning. Your numbers were better than the street was expecting, but some of the headlines when you read through the news services is just talking about how earnings were down, not just for you, but for all of the oil majors, just because of where oil prices have come. How would you describe the environment right now?
Well, the first quarter was definitely down versus what we saw in the first quarter of last year. Mixed results versus the fourth quarter of last year. And so a kind of a choppy market, a mixed set of results for our different businesses. But I think importantly, what the results that we delivered in the first quarter demonstrate is the strength of the business model that we have, the strategy that we're executing, and all the transformational change that we've made and are continuing to make. It delivered, I think, very solid results for the quarter. But much more importantly, it sets the company up for handling all the uncertainty and the volatility that we're seeing today and that we anticipate, frankly, as we move through the years going forward. So we've built a company that basically is prepared and ready to handle the kind of turbulence that we're seeing in the markets today.
What makes you think that the turbulence is going to continue through the rest of this year? We're watching WTI. I think it's just below $60 a barrel this morning.
Well, the turbulence I'm speaking about is the inherent turbulence associated with our industry and the energy industry and the fact that it plays such a pivotal role in economies all around the world. And so what you tend to see over time is a lot of volatility. We've all seen the ups and downs of our industry. From our perspective, we're building a business that does very, very well in the bottom of the trough. And then obviously when you're at the top of the trough, things look a lot better. But everything that we're doing is focused on growing value and making sure that we have a business and a strategy that's robust to every piece of the cycle of the commodity cycle, not just the tops of the market. So we've seen a very substantial change in the industry's ability to ramp production down with the unconventional resource. So that resource is much more short cycle. And so depending on the pricing and the economics for every individual player, they'll make their decisions about what they choose to do and can take production off much faster today than maybe what you have seen historically with long cycle projects. For our company, the business that we've built, frankly, prices can go low and stay low for quite some time. And it won't necessitate a change in what we're doing with our distributions to shareholders or to the capital plans that we have and the investments that we're making. What we'll be focused on instead is maximizing NPV and the economics of what we're doing. So with the ability to adjust and the short cycle investments, those will all be made on economic decisions about where prices are at today and what we think is going to happen in the future and how do we maximize the value of that. But the good news is with the balance sheet that we have, with the earnings power that we have, with the cash that we're generating, we could stay right where we're at and continue with the strategy that we've had in place and the plans that we shared with our investors in December through this year and into next year, even at very low prices.
However, the real story is their cash-generating machine. Cash from operations totaled $53.3 billion over the trailing 12 months, compared to a sector median of just $528 million. That's not a typo. Exxon generates over 100 times more operating cash flow than the typical energy company. This massive cash generation enables them to fund AI energy infrastructure investments, while still returning $36 billion annually to shareholders through dividends and buybacks. Speaking of dividends, Exxon has maintained its dividend for 44 consecutive years, including a 4% increase in 2025. The current dividend of $3.96 per share yields 3.63%, with a sustainable payout ratio of just 51.9%. This means they could maintain the dividend even if earnings fell by half, providing downside protection for income-focused investors. Their share buyback program adds another layer of shareholder returns. They repurchased $4.8 billion worth of stock in the first quarter alone, with a target of $20 billion in buybacks for the entire year. Combined with dividends, this represents a total shareholder yield of about 6% annually. Now, let's talk valuation, because this is where the opportunity becomes clear. Exxon's price-to-earnings ratio of 14.5 times appears expensive compared to the sector median of 11.45 times, but it's actually reasonable when considering its superior profitability and cash generation. More importantly, Their discounted cash flow fair value of $340 suggests 211% upside from current levels around $109. Even if you don't believe in such dramatic upside, the Wall Street consensus price target of 124 represents 14% near-term appreciation. The range of price targets goes from a low of $95 to a high of $147, with most analysts seeing double-digit percentage upside over the next 12 months. One area where Exxon trades at a premium is its EV to EBITDA ratio of 7.6 times, compared to the sector median of 6.5 times. However, this premium reflects the market's recognition of their superior asset quality and financial strength. When you're buying the highest quality company in the sector, you should expect to pay a modest premium. The Seeking Alpha Quant rating assigns Exxon an overall score of 4.74 out of 5, translating to a strong buy recommendation. They rank 5th out of 228 stocks in the energy sector and 2nd out of 17 integrated oil and gas companies. The breakdown shows an A+ grade for profitability, which confirms our analysis of their superior margins and cash generation. Now that you understand why Exxon represents such a compelling opportunity, let me share 3 specific strategies for building your position and maximizing your returns. Strategy number 1 is dollar cost averaging, which I recommend for most investors. This involves buying a fixed dollar amount of Exxon stock every month for 6 to 24 months, regardless of the stock price. For example, you might buy $1,000 worth of stock every month for 2 years, investing a total of $24,000 over the 2 years. The advantage of dollar cost averaging is that it removes the pressure of trying to time the market perfectly. You'll buy some shares when the stock is higher and some when it's lower, smoothing out your average cost basis. Given the volatility around the September arbitration decision and quarterly earnings reports, this approach helps reduce timing risk. Strategy number 2 is for more sophisticated investors who understand options, selling cash-secured puts. This involves selling put options with strike prices ranging from $95 to $100 and expiration dates 3 months away. You collect a premium of roughly $2 to $3 per contract, which translates to an annualized yield of 15% to 18%. If the stock stays above your strike price, you keep the premium as profit. If the stock falls below the strike price, you will be assigned and required to buy 100 shares at the strike price. However, here's the beauty. Your effective cost basis is the strike price minus the premium you collected. So if you sell a $100 put and collect $2 in premium, your effective cost is $98 per share. Strategy number 3 is for existing shareholders. Selling covered calls. Once you own at least 100 shares of Exxon, you can sell call options with strike prices around $150 to generate additional monthly income. You might collect $150 to $200 per contract each month, which adds up to meaningful income over time. The risk with covered calls is that if the stock rises above your strike price, your shares get called away, and you miss out on further upside. However, if you're seeking income and don't mind limiting your upside to 15 to 20% gains, this can be an effective strategy. For portfolio allocation, I recommend different approaches based on your risk tolerance. Conservative investors might allocate 15% to Exxon, with an additional 5% cash reserve for opportunities. Moderate risk investors could allocate 25% to Exxon, with 10% in cash. Aggressive investors might allocate 35% to Exxon, though I wouldn't recommend going higher than that in any single stock. Remember, this is an investment with a 2 to 5 year holding period. The AI energy thesis will unfold over time, and the Guyana arbitration will provide a near-term catalyst in September 2025. Don't expect overnight results, but do expect this to be one of the most profitable investment themes of the next decade. Let me summarize everything for you. We're witnessing the beginning of the most significant energy transition since the discovery of oil itself. The AI revolution requires massive amounts of reliable electricity, and natural gas is the only fuel that can bridge us to the nuclear future fast enough. Exxon Mobil represents the ultimate picks and shovels play for this transition. They control the natural gas supply, are building the power plants, and have the financial resources to invest heavily in AI energy infrastructure. The September arbitration decision in Guyana provides additional upside optionality. However, the AI energy thesis remains viable regardless of that outcome. Wall Street is completely missing this story. They're still valuing Exxon as a cyclical oil company when it's actually transforming into an AI energy infrastructure provider. This disconnect between perception and reality creates the kind of asymmetric opportunity that generates life-changing returns. The best time to plant a tree was 20 years ago. The second best time is right now. While everyone else is chasing overvalued tech stocks, you have the opportunity to position yourself for what I believe will be the investment story of the decade. Start building your Exxon position today through dollar cost averaging. Consider using cash-secured puts to lower your cost basis if you're comfortable with options. Monitor the September arbitration decision as a potential catalyst for further action. And most importantly, think like an investor, not a trader. This is a multi-year wealth-building opportunity, not a quick flip. The AI revolution is just getting started, and it will require significantly more electricity. Make sure you own the companies that will provide that power. Subscribe to Warren's Money Buffet for more hidden investment opportunities that Wall Street doesn't want you to know about. And remember, the most immense fortunes are made by buying what everyone thinks is boring and holding until everyone realizes how valuable it is. The AI energy war is here. Make sure you're positioned on the winning side. Thanks for watching, and be on the lookout for more stock deep dives. Ready to dive deeper? Like, subscribe, and hit that notification bell. Join the Warren's Money Buffet community today for continuous financial growth.